Warren Buffett is often called the greatest investor of all time. But here's something you might not know: even Buffett makes mistakes. Yes, the Oracle of Omaha has had some serious missteps in his career. In fact, one of his biggest mistakes cost him hundreds of millions of dollars. In 1993, Buffett bought Dexter Shoe Company for $433 million. It turned out to be a complete disaster. He later admitted he had lost almost all of that money. That's a huge loss for someone with a net worth of over $100 billion. But here's the kicker: this wasn't the only time Buffett stumbled. Over the years, he's made some surprising decisions that didn't turn out as planned. Yet, despite these mistakes, Buffett has become richer and wiser. So, what can we learn from his biggest failures? In this video, we'll break down Warren Buffett's most shocking investment mistakes. We'll uncover what went wrong, what he learned, and how his missteps can teach you to become a better investor. Ready for some unexpected lessons from the man who's made billions? Let's dive in. Chapter 1. The Oracle's Oops. What went wrong? Warren Buffett is widely regarded as one of the greatest investors of all time. But even he isn't immune to making mistakes. One of his biggest missteps was with Dexter Shoe Company, a company he acquired for $433 million in 1993. Unfortunately, that investment became a massive loss. Dexter's shoes lost their competitive edge, and Buffett admitted he had made a mistake. "If I'd known then what I know now, I would never have bought it," Buffett said in 2008. Buffett's mistake wasn't just that Dexter's shoes failed, it was that he had underestimated the speed at which the market could change. The shoe industry had already begun shifting toward lower-cost producers, and Dexter wasn't prepared. Dexter's downfall showed Buffett that you can't just look at past success. You need to assess how a business will adapt to future market conditions. Another noteworthy mistake came from his initial hesitation to invest in technology stocks. In the 1990s, Buffett stayed away from tech companies, famously stating, "We don't invest in technology because we don't understand it." This was a smart move given the dot-com crash, but by the early 2000s, Buffett changed his strategy and invested in IBM, only to see it struggle. This hesitation and eventual misstep showed that even the most disciplined investors can face pressure to change strategies. Despite these errors, Buffett's ability to bounce back and continue making wise investments speaks volumes about his long-term approach. It's important to remember that even the best investors make mistakes, but they learn from them. Buffett's transparency in discussing his errors teaches us that owning up to mistakes is crucial in any investment journey. Chapter 2. Buffett versus Emotions. The hidden danger in investing. Warren Buffett often speaks about controlling your emotions when investing. In his famous annual letter to shareholders, he emphasized the importance of staying greedy when others are fearful and fearful when others are greedy. However, emotions can creep in even for Buffett. In 2008, during the global financial crisis, Buffett stuck to his strategy of buying undervalued companies, but he also made some rushed decisions in the heat of the moment. One of these was his investment in Goldman Sachs. While the investment turned out to be profitable, Buffett admitted that at the time, he was emotionally affected by the fear and panic around the market. Investing based on emotions can cloud judgment, and Buffett himself learned that lesson. Emotional investing can often lead to overpaying for stocks or jumping into volatile markets. For instance, his brief flirtation with technology stocks wasn't guided by clear reasoning but rather by the emotional drive to not miss out. Buffett's mistake with Dexter Shoe also involved a rush of confidence. He ignored his own rule of sticking to businesses he understood. This was driven by his belief in the company's brand, but the emotional bias of nostalgia and familiarity cost him. Chapter 3. The Growth Trap. Why bigger isn't always better. For years, Buffett has preached the value of investing in businesses with a moat, a competitive edge that protects them from competitors. But even with this principle, Buffett made a misstep by underestimating the challenges of scaling too fast. One example is his investment in NetJets, a private jet company. While the idea of fractional jet ownership seemed promising, the market was smaller and more competitive than Buffett expected. Over time, NetJets struggled with higher costs and economic downturns, which hit luxury markets hard. This teaches us that not all businesses can scale endlessly without hitting roadblocks. Bigger doesn't always mean better. Buffett also learned this with his investment in PetSmart. Though the company grew rapidly, it ultimately faced tougher competition from online retailers like Amazon, which disrupted the traditional pet retail industry. PetSmart's inability to adapt to e-commerce trends shows how growth can sometimes blind investors to the real risks in the market. Buffett has admitted that it's important to stay grounded and look for quality businesses that have room to grow, but not just any growth. Instead, growth that aligns with a company's core strengths is the type that will create long-term value. Don't forget to hit that subscribe button if you want more insights on Buffett's investing strategies and how you can apply them to your own portfolio. Chapter 4. The Value of Patience. Buffett's secret to avoiding regret. Buffett's investment strategy is rooted in patience. He famously said, "The stock market is a device for transferring money from the impatient to the patient." This patience is key to avoiding investment mistakes. While many investors panic during market downturns, Buffett stays calm and sticks to his long-term strategy. His decision to hold on to Coca-Cola since the late 1980s is a perfect example. Even when Coca-Cola faced temporary challenges in the early 2000s, Buffett never wavered. His ability to remain patient allowed him to watch Coca-Cola's stock rise steadily over time, providing massive returns. Buffett's patience extends beyond just holding on to good investments. It also means waiting for the right opportunity. In 2008, during the financial crisis, many were selling their stocks, but Buffett was buying. He invested $5 billion in Goldman Sachs when the company was struggling. His patience paid off, as he made a significant return on that investment. However, even with all his patience, Buffett has made mistakes when he wasn't patient enough. For example, his rush into technology stocks during the early 2000s wasn't his usual calm, calculated approach. Sometimes, impatience can lead to buying into overhyped stocks or trends that don't align with long-term value. Chapter 5. When Good Businesses Go Bad. A Buffett Paradox. Warren Buffett's investment strategy is all about buying good businesses at a fair price. But sometimes, even good businesses can go bad. One example is See's Candies, which Buffett initially praised as a perfect business. However, over the years, the brand lost its competitive edge as healthier snacks became more popular, and it became harder to maintain growth. Despite this, Buffett has held onto his investment in See's for decades, reasoning that the company's consistent cash flow and strong brand still make it valuable. This paradox highlights an important lesson. Sometimes, even the best businesses don't last forever, but patience can still yield long-term returns if the company's fundamentals remain solid. Similarly, Buffett's investment in Buffalo News was initially successful, but the newspaper industry faced an existential crisis due to the rise of digital media. Buffett's attachment to a traditionally profitable business led to holding on to something that eventually lost value. Buffett's lesson from these experiences is clear: businesses, no matter how well established, can face decline. It's crucial to know when to cut your losses and move on, but also understand when the business still has value in other ways, like cash flow or brand recognition. Chapter 6. Beyond the Buffett Formula. Investing for the new generation. As the world changes, so too does the investing landscape. Buffett's approach, focused on value investing, has stood the test of time, but today's investors need to adapt to new challenges. The rise of tech companies has made traditional investing more complex. Buffett, who famously avoided tech stocks for years, now owns significant stakes in companies like Apple. He saw that Apple's ecosystem and brand loyalty created a moat that could be valuable in the long run. But this shift shows that even the Oracle of Omaha must evolve. For young investors, it's essential to consider both traditional value investing principles and the new realities of today's digital economy. Look for companies that have strong fundamentals, but also keep an eye on emerging industries like artificial intelligence and renewable energy. The key to applying Buffett's wisdom today is knowing how to combine his timeless principles with the opportunities of the future. Technology, social media, and new business models are reshaping markets. Buffett's recent investments in Amazon and Snowflake show that even value investors must keep pace with innovation. Make sure to subscribe for more exclusive insights into how to grow your wealth and learn from the best in the game.